What if I told you most token sales today are designed for you to lose money? Not because you're bad at investing, not because you missed something, but because the system was never built for you to win. In 2025, only 6 out of 41 token sales are still profitable today. So the real question is, what happened to crypto fundraising? And why did retail become exit liquidity? Let's rewind. Token sales used to be simple. Early access, lower price, higher upside. But today, that logic is broken. According to data discussed by Fabrizio from Legion, based on a Masari report, if a project launches below $50 million valuation, investors usually win. Sweet spot, $25 million to $50 million, up to 105% returns. But above $50 million, almost always losses. So what changed? Here's how modern token sales actually work. A project raises from VCs at $30 million valuation. Next round, $100 million. Public sale, $200 million or more. By the time you enter, the upside is already gone. Then the profit machine starts. Influencers get paid to promote. Exchanges charge huge listing fees. Market makers get tokens and profit, even if price drops. Supply is restricted. Price pumps artificially. Futures launch. Retail gets liquidated. Big players buy cheaper over the counter. And guess what? Everyone in this chain is already in profit, except you. Retail investors are the last step in the chain. You do research. You fight for allocation. You wait months. You believe in the project. And then, price drops after TGE. Because early players don't care anymore. They already made their money. You didn't invest early. You invested late, into a system designed to exit on you. So why don't founders just lower valuations? Simple, they can't. If they drop the price, they destroy relationships with early investors. So instead they keep valuations high, hope the market absorbs the pressure, push risk onto retail. It's not personal, it's structural. Here's the interesting part. Platforms like Legion are already reacting. For the past 3 months, they reject projects with inflated valuations. They negotiate lower entry prices. Because real opportunity is when buyers can actually profit, not just fund everyone else's exit. To really understand what's happening, you need to zoom out, because this didn't happen overnight. This is the evolution of token sales. Stage 1, the Wild West, 2017 to 2018. Back then, it was chaos. You just sent ETH to a smart contract and hoped for the best. No KYC, no checks, no rules. Funds raised nearly $5 billion in a year. Projects like EOS raised $4.1 billion. It felt like free money, but in reality, it was a casino. And when the market crashed, 80% of projects died. Retail lost billions. Regulators stepped in. China banned ICOs. The US Securities and Exchange Commission started cracking down. ICOs didn't evolve, they collapsed. Then came structure. Stage 2, the safe era, 2019 to 2021. Enter IEOs and launchpads. Platforms like Binance Launchpad started vetting projects. Now it felt safer. KYC, due diligence, curated access. DEX launchpads like Polkastarter and DAO Maker followed. Projects like Axie Infinity and Polygon launched successfully. But then, the system scaled too fast. Launchpads became factories. Project, quick check, sell to retail. And once again, quality started to drop.
Stage 3, the Illusion of Due Diligence, 2021 to 2023. Now things looked even more professional. Deep project analysis, tokenomics reviews, community voting, tier systems. It felt like, if it passed all this, it must be good. But there was one hidden problem. Entry prices were already too high. VCs entered early at extremely low valuations. Retail bought at inflated public prices. And when the bear market hit, many tokens dropped 90% or more. Not because projects were fake, but because the math didn't work anymore. Stage 4, the extraction era, 2024 to 2026. This is where we are now. And this stage is different. It's not broken by accident, it's optimized. Projects raise at $50 million to $200 million or more. Public sale, even higher valuation. Low float, artificial pumps. Perps, liquidation engine. OTC deals, insiders get discounts. According to the Masari report, median returns after around 300 days, minus 88% to minus 96%. And suddenly, everything makes sense. The system doesn't need you to win, it needs you to be exit liquidity. But here's the twist. Every time retail gets wiped out, the system resets, and we're already seeing the shift. Lower launch valuations, $20 million to $50 million. Higher float at launch, 15 to 25%. Less insider advantage, more transparent allocations. Because without that, there's no demand left. And without demand, the whole system stops working. Now we're entering a new phase. Less hype, more real utility, fairer entry points. Almost like crypto is coming back to its roots. So next time you see a hot token sale trending everywhere, pause for a second. Ask yourself, is this real opportunity, or am I just someone else's exit? Because in today's market, you don't lose because you're late. You lose because the price was never meant for you to win. But here's the good news. Now you know how the system works. And once you see it, you can't unsee it. If you want to stay ahead of the crowd and catch real opportunities before they get overpriced, follow Crypto Smart Hub. Like the video, subscribe, and next time you invest, make sure you're early in the cycle, not the end of it.